welcome back, everyone. Thank you for joining us for another Apriem virtual event. For those of you who have joined us before, thank you for coming back. And for those of you that this is your first time, we're so excited to see you and hope you enjoy the content that we pulled together for you today. So today's topic is personal finance tips and tricks. Before we really get started, I'd like to just kind of cover a couple of key items that I think are really important. Number one, please go ahead, silence your cell phones. I've silenced mine, so it won't be interrupting us at all during our presentation today. Number two, we have set aside an hour total for the presentation today. And so that means that we'll probably have about 45 minutes or so for the actual presentations itself. And then we allow about 15 minutes for questions to come in at the end. With that said, in order to ask a question, you have to submit it using the toolbar or that Q&A feature that's available in your toolbar there through Zoom. Go ahead and submit them along the way. I will be monitoring those questions as they come in, and in certain circumstances, we'll answer along the way. Other times, we'll just save it and we'll cover it at the very end. My name's Josh Garland. I will be the host of today's webinar on personal finance tips and tricks. And then I'm going to go ahead and introduce our two guest speakers. So let's go ahead and go here so we can get Cole in the shot with us as well. All right. And so today we have Megan Schwab. She is a financial planner here at Apriem Advisors. She graduated from Biola University in 2018 with a degree in accounting, got her start here at Apriem in 2002. She obtained her CFP designation in 2021. And then Cole, who's here with me, is an associate financial planner. And Cole, he graduated from Chapman University in 2018 with a degree in business administration. Cole joined the team in 2021 and is currently a CFP candidate. And so with that, I will go ahead and turn it over to, I think, Megan, you're going to start us off, right?
Yes, thank you, Josh. So today we're really going to review some of the basics of personal finance. It's so important to have a good financial foundation, not only for yourself, but your family and the future generation as well. And yes, that can start in your 20s and when you're just starting out on your own. And so the purpose of today's webinar is really to think about how to start building that wealth. And we'll be bringing up different strategies and things to think about when it comes to how to save, where to save, and where you can make your money most productive for you. So I'll start us off by discussing the power of compounding, the differences between being an investor versus a trader, and the importance of asset allocation and asset location. And then Cole will bring all of these topics to life through some practical examples and how those can be applied. So I'm going to start off with a couple of questions, and maybe you've been asked this before, so feel free to answer them in the chat box below. So if you took a single penny and doubled it every day for 27 days, how much money would you have? So for example, I have 1 penny today, 2 pennies tomorrow, 4 the next day, then 8, then 16, so on and so forth. So take a moment and type into the chat box and tell me what you think.
And so you guys can either put that in the Q&A box there if you want to do an answer that way, or you're welcome to just do it as a direct message to the whole group in the chat box if you like.
Let's see. What do you think it is, Josh?
I have an unfair advantage because I happen to know the answer already. So I'm not going to cheat, but we do have a couple that have come through here. I've got one that says $1 million. I have another one that says $10 million. I think everyone's really shooting for the stars here. They know it's going to be a high number already.
Yeah, those ones are a little too high. So the answer is $671,088.64. So what if instead you doubled that penny for 30 days? So just 3 more days than previously.
All right, go ahead and put in your second guesses, folks. 3 extra days. All right, we've got a $1,001,001. Hedging our bets here. All right, any more? Any last minutes? I think we're good. Megan, what do we have?
It's just over $5.3 million, which is crazy to think the power of doubling that just for 3 more days. And I really bring all this up because compound interest is notoriously a difficult thing for humans to comprehend. And one of the biggest reasons for that is just how we're inclined to think. So naturally, we think very linearly, and compounding interest is built on a geometrical thinking process. So, Josh, if I were to ask you, what is 3 plus 3 plus 3 plus 3?
12.
What's the answer? Exactly. So it's pretty easy to come up with the sum of 12 fairly quickly. But Josh, instead, if I asked what is 3 times 3 times 3 times 3, finding that answer may take a little more time for you to come up with without using a calculator.
I've got it. It's
What
3
is
to the power of 4.
Yes, and the answer is 81. So, yeah, I bring this all up to say it's one of the reasons why we need to intentionally choose to save. In the moment, it can be really difficult to see the benefits because we're not naturally inclined to think in these exponential terms. So whether it's for saving for a new home or a car or retirement or just to have extra on a rainy day, it's an important practice to be in. And so later on, Cole's going to go over some of those practices that will hopefully make it easier to get into the mindset of saving. All right. And then, so Einstein, it's argued if he said this, but it's argued that he said that compound interest is the 8th wonder of the world, and the one who understands it earns it, and the one who doesn't pays it. And I think it's really important to understand how compounding can work against you. A lot of people talk about how it can work for you, but there's some very real examples of how it can go already pretty fast. And so one of those examples is credit card debt. Say you have $1,000 on a credit card and you have a high annual rate, let's call it 20%. At the end of the month, you don't pay the entire outstanding amount of $1,000. So before the next billing date, you still have that $1,000 and you're going to start accruing interest. So at the end of each day that there's still an outstanding balance of $1,000, the credit card interest is calculated and added to your balance for the next day. So the interest you've been charged on today is then added to the balance on which interest is charged on tomorrow, and then the next day, and the next. And this is why you hear so many stories of credit card debt spiraling out of control. And that'll bring us back to a point Cole will talk about later about the importance of budgeting and being aware of where your finances are going. But I thought there's value in bringing up how compound interest can work in both ways. And so, of course, one of the biggest points of today is talking about how compounding can work for you, which is through investing and saving. And so on the next slide, I actually have an example of how it works for you and how this can be applied in a positive way. So again, let's use this $1,000. Say I have an extra $1,000 a month that I can set aside for 20 years. Immediately, there's 2 things that are happening. One, there's a regular occurrence of new money being put into an account, which is increasing the balance. And then 2, the funds are earning interest either in a savings account or they're being invested in a brokerage account, which is compounding on an annual basis. So we show these 2 graphs side by side to illustrate the impact of putting funds in a savings account, which is on the left-hand side, versus taking a little more risk and investing those funds. It's important to note that on the right-hand side of the graph, you see more exponential growth. And in this model, we're looking at funds that are growing at a 6.5% rate, which is a traditionally 50% bond, 50% stock portfolio. And the reason I use this conservative type of strategy is I want to show that you don't have to invest very aggressively to experience the impact of compound interest. Frankly, if this person just saved into a savings account, they would experience compounding with the little interest that their savings account is earning. But taking a little bit more risk can go a really long way, as we see on the right-hand side of the graph.
Yeah, I really like this, Megan. I think this does a really good job of helping to not just explain the power of compound interest, but also how being too conservative along the way could potentially hurt you. And it doesn't take that much additional risk in order to generate a bit, of a higher yield for someone, especially when you're talking someone who's younger, that has a long time horizon left for growth. So really, really powerful shot here or presentation here.
Exactly. And thanks for bringing that up, Josh. You can think about this way too. The younger you are when you start investing, the more room you have to experience, fluctuations in the market, which are inevitable. But there's more time to recover and reap the benefits of being a patient investor. So that takes us right into the next slide about investing. So I think the concepts of trading and investing, sometimes people talk about them in very interchangeable ways. So trading is the buying and selling of securities, but the success depends on the trader's ability to be profitable over time. In other words, are they buying and selling on a daily basis at the right time? And timing the market is so difficult to do. And that's why here at Apriem, we focus a lot on being investors, and that's a big value for us. And so investing is purchasing assets with the intention of holding them for the long term. So whether you invest professionally or you just like to do it for fun, it's always ideal to do it with the idea in mind of, can I hold this company for a long time, and can it weather a storm? Because, XYZ company may be have the coolest technology, be all over the news, be something super exciting, but maybe its financials and backbone aren't the strongest to be investing in. And so that's one of the things we do here at Apriem, and we really encourage you to do as well personally, is if you are going to invest, you need to look at these companies with a long-term lens. Something that Warren Buffett once said is, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So just something to keep in mind. And I think it brings us into this next graph that we're going to show as well. So in this graph, we're looking at a sample investor who invested money 4 different times into the S&P 500. A little background on this person: they're a long-term investor, and they had the idea to buy and hold, and that's what they did. But you notice when they chose to start investing and be in the S&P, it was at really inopportune times. Back in 1973, right after this hypothetical person invested, the market dropped 43%. And again, a few years later, they invested $50,000 more, and the market dropped again 20%, and so on and so forth. You can see the trend. But because that person bought and hold and was an investor and wasn't in and out of the market whenever the market did take huge swings, they began to reap the benefits later on, as you can see at the tail end of the graph on the right-hand side.
Yeah, I think this is another really powerful graph. I've seen this story or this concept of, time in the market is more valuable than timing the market. And I've seen it displayed in a lot of different ways, but I think this might be one of my favorites, right? Because you're really looking at that, what's not necessarily worst case scenario, but what's a really poor scenario? What if my timing was just wrong every time? Does buy and hold still work over a long extended period of time? Right. And I mean, in this case, we're talking about these $50,000 investments, 4 of them at very inopportune times, multiple times, but then continuing to have that emotional fortitude to just hold on for the ride. Right. And I think what's amazing is right there at the end, when you're looking at, okay, even after basically right at the end of the market decline that we saw in 2020 due to COVID, right? The account had still grown to $1 million over that time period by March of 2020. Right. But then October 2021, right, not much longer, all of a sudden we've gained an additional $800,000 from the market return that came back up. And so when we initially were looking at this, it got my mind going and thinking about that old adage of, over the past 100 years, the S&P 500 index has averaged approximately 9% per year. And I was thinking, well, what's it been over the most recent 10 years? And I did this math about a week ago. And including last year, where the S&P 500 index was down negative 19.8%, almost negative 20%, that average annual return came out to about 10.26% per year, compounding. That's the most recent 10 years. So you're talking 2013 to present. I just thought it was fascinating, because I think when we're looking at things, with a magnifying glass on a day-to-day basis, and we're dealing with things like what's been happening with the banks and the rising interest rates and inflation and Ukraine and Russia, right? Those isolated small events can feel like they're having these massive effects. But then when we take a few steps back and we look over a long, broad picture, it reminds us of why at Apriem we've taken that investor's standpoint, or that investor's approach to accumulation over time. So anyway, I love this. Megan, I'll turn it back over to you.
Sure. Thank you for including all that, Josh. Yeah, so this really highlights the idea of why we want to be investors. And I want to take a moment just to talk about a program we have here at Apriem for people who are new to investing, because the idea of researching these companies and knowing what to look for, what makes a good company, it can be kind of daunting and a lot of work. But for newer investors, we do have a program that we call Foundational Asset Management, or FAM for short. And it is a robo-advising program where the monies you have that you want to invest, they're put into what are called ETFs, or exchange traded funds. And these exchange traded funds are simply groups of companies that are pooled together. So for example, if I invested $1,000 into an ETF, I could get exposure to hundreds of different companies. And since this is all robo-advising, or robotic, as the name implies, an investor doesn't necessarily need to worry about making trades or doing the research on these companies themselves, because that's already being done in the background. And then along with this program, our FAM clients get access to Cole and myself for financial planning conversations. And this brings us back to Apriem's idea that it's hard to advise someone if we don't know their finances or how they're invested. And so this is just another way for us to be aligned with newer investors and really learn what their goals are. Are they looking to buy their first house? Are they getting married and have those wedding expenses coming up? Or, did they incur a lot of debt? And do they need help figuring out a plan to pay that off so that they can start building that foundation by saving and investing? And so that experience is really tailored to your specific needs. But I think it's a great opportunity to at least get used to investing and what that is like in a format that is a bit more approachable. And so moving on to asset allocation versus asset location. These are two concepts that are really important to think about, especially when you're starting out. So asset allocation asks the question of, how are my assets invested? Typically someone's invested in stocks, in bonds, maybe they have real estate, a primary home, or maybe some rental properties. Maybe they have some cash sitting in a savings account or somewhere at home. Business interests can be a form of investment. The list goes on. And it's important to understand how personally you are invested. Depending on your age, for example, you might be more invested in stocks than you are bonds, because you have more time to take bigger risks and experience those bigger fluctuations in the market, versus when you're in retirement and your goals change. Now you're looking for a steady stream of income because you have to live off of those investments. And so your allocation is meant to change over time with your needs and life stages. But it is important along the way to know where that's at. For example, if you're young and just bought your first house, well, you might be heavily allocated in real estate because you used up a lot of your savings to purchase that home. And that's not necessarily a bad thing, as long as once you purchase the home and get settled, your focus shifts to building up that cash savings and investment savings that you had once before. So that's just one aspect of it. And then that takes us to asset location. So I like to think of it as where are my monies physically held? Are they in a checking account, savings account, brokerage account, or some type of retirement account? And it's really important that we do have diversity in the location of our assets. A good example of this is, say you work 40 years and you're diligently saving into your 401k. But that's where all of your savings is going to during your working years. And you get to age, call it 55, and decide you want to retire. Well, if all of your savings is in a retirement account that you can't access without incurring fees or penalties until age 59 and a half, well, then we have 4.5 years where we need to figure out, okay, how am I able to supplement my living expenses while not taking in income? And of course, there's strategies to help with that if you do find yourself in that situation. But when you're younger and starting out in this savings journey, it's good to have a spread of assets in a brokerage account versus a retirement account. And then with that, I'm going to go ahead and pass it on to Cole, and he's going to give us some examples of all of this information that I just provided and how it can be applied.
Awesome. Thanks, Megan. So yeah, a great way to really break down an individual's financials is to look at a cash flow analysis. This is something that, Josh, myself, and Megan really look at when we're first getting to know a client, right? Because we really want to be accurate as possible of what's going in and what's going out. So let's just look at a hypothetical situation here. So this person is single, age 34, has an income of $120,000, living expenses worth $50,000, retirement and taxable accounts growth rate at 9.64%, or in other words, this is an aggressive growth model. Or another way to put it is 100% equities. So taking a lot of risk. This is just because of being younger and your time horizon is a lot longer. We have their cash accounts scoring at 0%, being ultra conservative in that way, because more times than not, you're maybe getting 1% or something less than that. For salary and bonus, we have a 3% inflation index, and same with living expenses with a 3% inflation index. Going to inflation, I know as of this last year, it was higher than that 3%. We do get those questions a lot, but this is just an average, right? Because we expect that to come down in the near future, but that's in the system as well. So if we go ahead and look at the first red box there,
Again.
There we go. All right, so we do have the taxable investments at $83,793, retirement accounts 56,150, and cash accounts of $80,000. If you look into the next year, right, we still have those growing with the growth rates, like I said before. Now we go into cash inflows. We have that $120,000 per year, and then we have the third red box here, we have living expenses, spent savings, and taxes. If you kind of notice here, the living expenses, spent savings, and total taxes all equal $120,000, equaling our cash inflows. So you can basically kind of clearly see that this person is not saving, but we're being ultra conservative and telling that the software that we're actually spending this $120,000 per year. So why do I bring this up? So when income is higher than expenses with no planned savings, right? This means that we have excess funds that are being unaccounted for. And this is kind of a red flag when in financial planning, that we're trying to be accountable for all funds coming in.
Yeah, I think this is something that comes up often where we'll go through and we'll do some budgeting. We're going to look at expenses, right? And we look at income, and oftentimes our listed expenses are quite low in comparison to our overall income that we have coming in each year, but there's no planned savings. When you're putting a cash flow analysis like this together, it's really, really important that we're telling the system where every dollar is going. Everything should be accounted for, even if it means, hey, I'm not really saving it. It's not really going in, my real like essential overhead expenses, right? But we're spending all that extra. I'm not directing it to go anywhere special.
Exactly. So yeah, so this might be due to living expenses being, typically wrong. So we really plan by telling the software that this excess $33,512 is actually being spent, right? So we're being conservative and more accurate that way. But this comes up to a really known financial behavior that's really natural to know exactly what you earn per year, right? Because it's, probably that's an ego thing, right? You really are happy about, your income or salary.
I got that raise. I got that bonus.
Exactly.
Right?
But you're not really sure what's going out, and this can be a big problem. So our team has come across multiple scenarios of this, and we cannot stress enough of really focusing on the cash outflow perspective, because that's truly what is really more important. So we really urge to track expenses monthly, know what you are truly saving per month, and get on a budget if necessary. And I'll go ahead and transition into the next slide where we talk about budgeting. So this is a basic, rule for budgeting. It's called the 70-20-10. And what this brings up for is a early stage accumulator. And what defines the early stage accumulator? So this person has a decent amount of expenses or debt, lives paycheck to paycheck, is still renting, so no mortgage on a property, has never budgeted before, and wants a simple budget method. And this really breaks it down for you in a good way. So 70% of the income is going to fixed or variable expenses. 20% is going to savings or paying off debt. And then 10% is actually going into investable accounts, or you can donate that to charity if you are inclined to do that. But to give you a couple of examples of fixed expenses, so this is going to be your rent or your mortgage payment. This is going to be your utility bills. This is going to be any type of loans that you may have. So the big ones are going to be your auto loan. And another example is insurance premiums. Right. So your fixed expenses are not going to be, they're not going to be changing. They're fixed, right? You're going to have to pay those every year in order to live. And then examples of variable expenses are going to be your groceries, any type of travel, your gas, any type of entertainment, hobbies, stuff like this. But this is a good place to really talk about, balance, right? Talking about variable expenses, you can really easy and try to cut these expenses. And a good way to start that is, with variable expenses.
Yeah. Just to add in really quick too, when you look at your budget and you find that you're spending 85-95% of your income on expenses in general, well, maybe it's time to step back and take a hard look at things like, am I paying too much in rent? Do I have to find a different apartment? Do I need the phone plan that gives me the most? So there could be areas in the fixed category that could be cut back in their ways. But like Cole said, those are always going to be there. So with fixed expenses, it's more of being mindful of, well, how much apartment can I afford? How much car can I afford? And things of that nature.
Yeah, thanks, Megan. So this kind of really transitions well into the next slide when we talk about saving, right? So right when we start budgeting, when we find out, what, I can actually save, I have a couple $100 or a couple $1,000, where can I now put that and use, the biggest benefit, the saving? So talking about saving, so a big feature of this software, it really allows us to see any value lost or value gained in the future for the decisions that we make today. This is another way to explain opportunity cost. So this This is the same scenario as last time with a little few changes. So again, so this person is single, age 34, income with $120,000, living expenses of $50,000, and then an average growth rate of all accounts is roughly 6%. So this is an average of your retirement accounts, your taxable accounts, and your cash accounts. But yeah, so in this example, we're really showing the decision of no monthly savings compared to a regular monthly savings on the right there. But a couple of things to know what's really happening inside the graph, right? Inside one of those blue bars. So each bar is actually 1 calendar year. And it actually might be a little hard for you to see, but in the year 2054, there's a little sunset there that this is this person's retirement age of 65. And then the bars are accounting for income, checking, savings, retirement, and taxable accounts, plus their growth rates, minus their yearly expenses. A big key factor here is it's never going to include real estate, right? So real estate is illiquid, and this is just liquid accounts inside your portfolio that we can invest in. So you can see it's growing year over year since the expenses match the income, and the accounts are earning an average growth rate of 6% each year, going back to Megan's point of compounding interest. So really explaining these graphs again. So the graph on the left shows no monthly savings, no extra value gain, since we are not making any changes to the graph, right? This is just what we call base facts, right? All the information you give us, this is how your plan looks today with making no changes to it. And so you can see there roughly a total net worth right under 2.5 million. But the graph on the right, it shows a regular monthly savings schedule. So this client is choosing to save $6,000 per year, or just $500 per month. We are then putting that $500 into a brokerage account and having that brokerage account grow at 9.64% or aggressive growth into 100% equities. And this is the same strategy as before, since this person is young, their time horizon is long, right? And can take more risk since that time horizon is longer. So the graph shows that if we made this decision today, that will be a total value gained of $2.2 million roughly over the span of 60 years, right? So you can see in the beginning, roughly this starting in year 2023, there's not a lot of value gained, right? There will be, but over the span of 6 years, compounding that interest, you can see a true value gained in the year 2083.
Yeah, I think, there's some really great pieces here. So first off, I mean, the fact that, we're doing something productive with those dollars that we were just spending out before, right? And nearly doubling the net worth that we're at by the time we're getting to age 95 in this case. But I think one of the things that's really important here is kind of going back to what Megan talked about earlier when it comes to asset location, right? Now, imagine if all that savings had only been in your 401k, right? Or had only been in retirement accounts. Or only been in something like annuities, right? Something where those funds are locked up and you can't access them. And what happens if somewhere along the way, your best friend comes and says, hey, I got a business venture and you really like the idea and you want to invest, right? Well, all of my money's locked up in this retirement account. I can't get to it without penalty and fees, right? Or maybe I want to buy a rental property, right? And I need some money for a down payment on that rental property, right? So I think that while we look at this and the green is all added together, we got to keep in mind that those different locations are really, really important along the way, because if we're not diversifying the locations that we're saving in, right, we lose out on that opportunity that you're talking about there. That opportunity cost comes into the picture. We miss out on the opportunity to invest in something that we might have wanted to along the way. Exactly.
Thanks, Josh, for that. But I think, as Megan and I have, talked to clients and stuff, the point here is that how easy savings can actually be, right? We can cut simple expenses like subscriptions, entertainment, or eating out. I know these aren't the most expensive, expenses, but it's an easy way to start and really break down of what, the cash outflows of what's going out.
They add up.
They do. They do. So really having your savings automatically deposited into an investable account like this, a brokerage account on the right here, can really put you and your family in a very, very comfortable, comfortable or better financial position in the future.
And I think it's important to note too, is people have asked me, well, how much monthly savings should I do? And that, of course, depends on what your income is and what your expenses are, but it's really important to understand that the amount you're saving across however many number of accounts, it can change as things in your life change. I remember when I was first starting out, that was a big struggle I had, was trying to figure out, okay, how much can I save and keep it reasonable? And in the beginning, there were some months where, I hypothetically tried to save $500, but at the time that was too much. So I had to cut back and save $300 a month instead, so that I could still meet my other obligations. So those types of monthly savings are subject to change. Of course, you want it to be regular and happening every month, but especially when you're starting out, there is a bit of trial and error as you're figuring out, okay, how far can my income take me? How much rent can I afford? I have to start paying my own car insurance now. I don't even know how much that is yet, type of thing. So just a little encouragement to add in there. If you're starting out, it's normal for it to fluctuate and change in the first year or so as you're trying to organize your finances.
Yeah, thanks, Megan. So I think this brings up a good point of transitioning into a different topic, but something that really is a big game changer, especially this year. So Megan, go ahead and transition to the Secure Act 2.0.
Thanks, Cole. Yeah, so the Secure Act 2.0 just became law on December 29th of 2022. And we thought this would be a good time just to go over high level some of the things that changed. I do want to point out that there was a lot that went into this Secure Act 2.0, and we're just covering some of the things that we think are most pertinent to the most people. So if you have more questions about the Secure Act or some of the other things that changed as a result, we encourage you to talk to your wealth manager, and we'd be happy to share that with you. But just to start, some of the big things that changed was the required minimum distribution age, or RMD age. And so this change is happening in two tiers, if you will. So for people born between 1951 and 1959, your RMD age increased to 73. And then those who are born in 1960 or later, they don't have to start taking RMDs until they're age 75. And this is great. Honestly, if you don't need to pull from your retirement accounts until you have to, why not push that off as long as we can? And so,
do you really quick want to just recap what exactly is an RMD, just for those listeners who aren't familiar with it, and why this would be important?
Sure. So an RMD, or required minimum distribution, is when you are forced, if you will, to pull funds from your retirement account. So for all of your working years, you've been deferring part of your paycheck into a tax-deferred retirement account. And so at RMD age, that's when Uncle Sam says, you know what, I've waited long enough. It's time for me to get my taxes in the form of a required minimum distribution.
And so, Megan, they've actually moved this age back a couple of times. Is that correct?
They have. So there's a lot can change between now and, for example, when I turn 75. So it's something that we at Apriem always keep our eye on, and always inform you when an age like this changes. But at least for now, this is the age that has been decided on.
Right. And so just recently, before Secure Act 2.0, that age for between 1951 and 1959 was 72. But then prior to that, it actually was 70 and a half was what those previous ages used to be. And it was 70 and a half for a long time prior to that. So this is the first time in a while we've really seen these changes come. I think COVID really kind of jump-started the big change coming around to begin with. And now, we're continuing to see them push these ages back, which is, it's not a bad thing. It's nice for us to be able to sit and compound and grow tax deferred longer. So I'm sorry to interrupt. Please continue.
Oh no, you're good. Yeah, and just to add on to that too, it like Josh said, it gives us more opportunity to find strategic ways to help you save on those taxes. So, for example, does it make sense to start doing Roth conversions before you hit that RMD age? Are there instances where maybe it makes sense to pull some funds from your retirement account before RMD age for tax purposes? And those are all questions we can answer for you when looking at your financial plan. Another couple things that have changed is catch-up contributions for individual retirement accounts. And so a catch-up contribution is additional money that you can contribute to a individual retirement account or IRA if you're over 50. For example, the contribution limit to an IRA is $6,500 a year right now. And if I'm over 50, I can contribute an additional $1,000 to that account each year. So for those 50 and older, right now you can contribute $7,500 a year to your IRA. And what's changed about that contribution limit for the catch-up contributions is those are now subject to inflation adjustments starting January 1st of next year. So historically, it's always been a catch-up contribution of a flat $1,000. But because this Secure Act 2.0 changed the rule, in 2024, we might see an increase, hypothetically, of, now you can contribute $1,020 as a catch-up contribution to the IRA. So that's basically what's changing there, giving you more opportunity to save more for retirement.
So there's something good coming from all this inflation.
And then qualified charitable distributions will be subject to that same inflation adjustment starting January 1st of 2024. For those who don't know what a qualified charitable distribution is, or QCD for short, what it is it allows you to take up to $100,000 out of your retirement account and gift it to a charity. And this can be done in lieu of taking your required minimum distribution. So not only are there tax benefits from gifting to a charity, but then you also get to give back to something that may be near and dear to your heart. So that $100,000 limit starting 2024 will now be subject to inflation adjustments or increases each year.
Yeah, this is a fantastic point and tool I just want to talk a little bit about, because there are surprisingly a lot of folks that are out there that maybe through their current sources of income and they keep their living expenses low, don't actually need those required minimum distributions. They're just being forced to take them. And in some circumstances, 100% of their RMD is not something that they need. They've just been forced to take it so that they can pay taxes on it. And so when you have a charity that's near and dear to your heart, this ability to then, gift those RMDs, essentially, save yourself from paying the taxes on it and give it to a cause that's near and dear to your heart, I think is fantastic. And the fact that they're starting to increase this now with inflation year after year, I think is a great thing as well.
Mm-hmm, definitely. And then the final change to the Secure Act 2.0 that I'm going to go over is the 529 plan. And so a 529 plan is an account that you can set up for your child, your grandchild, niece, nephew, anyone really, and we'll call them the beneficiary. And that account allows you to help pay for the beneficiary's education expenses. One of the considerations to make when looking at one of these accounts is the qualified expenses that come out of a 529 plan are limited to education only. So college, trade schools, the books associated with those courses you're taking is really what you're limited to. And so under the old rules, if you had a 529 plan beneficiary go through college or their trade school, and then there's still a balance left in their 529 plan account, you had two options. You could either transfer that account to a different beneficiary, so that person's brother, sister, a cousin, or you could take the funds out of the 529 plan but incur a penalty. And so something that the Secure Act 2.0 added was the opportunity for a 529 plan beneficiary to roll over up to $35,000 of their leftover plan funds into their own Roth IRA. And there are a lot of conditions surrounding this new benefit, but I do want to talk about two of them. The first is the 529 plan account must have existed for at least 15 years. So if your child's going to school in a year and you want to open a 529 plan for them, you couldn't fund it and then 4 years later start rolling it over into your child's new Roth IRA. It has to be a long established plan. And then another thing is the beneficiary must have their own earned income. So Jane Doe, for example, was a 529 plan beneficiary. She went through university, graduated, got a job, and then found out from her parents that she still had a balance in the 529 plan. Because she's working and earning her own income, she can then start initiating rollovers into this new Roth IRA account from the 529 plan. All right, and I'll go ahead and pass it back over to Cole.
All right, so really hammering down these contribution types. Megan stated one with the traditional IRA, but these were a few that made a significant increase or no change from the Secure Act. So just to go over a few, starting off with the first box there. So a 401k or 403b employee contribution for 2022 was $20,500. And now for 2023, it's actually $22,500. So increase of $2,000 for this year. Going a little down there, the catch-up contribution, so someone who is greater than 50, was $6,500 in 2022. Now that has increased to $7,500 for 2023. So increase of $1,000 there. So a pretty good chunk of change there just for your 401k or 403b. Going down to a traditional IRA, all right. Last year it was $6,000. Now for this year was $6,500. So increase in $500. And now just going back from a couple of slides ago, just talking about compounding interest, right? Think about just that $500 every year now being invested into your retirement, starting this year, right? The value gained is going to be tremendous over a long period of time. So it doesn't look like much today, like, $500. You get thinking about it over the long term can make a big impact to your financial plan.
Especially as they keep slowly but surely increasing that amount year over year.
Exactly. Dropping it down to a Roth IRA, same type of change, right? Was $6,000. Now it is $6,500. So a positive change of $500. Lastly, I want to bring up just the catch-up contributions for both of those, right? You can see that there's no change there. But as Megan stated before, right, it's going to be linked to inflation starting next year. So you'll start to see a little bit of a increase there, just depending on what the current inflation index at that time will be. But this is a good graph really showing every type of account. I know some of these accounts don't apply to you, but it's also great to know that, for certain accounts, there was a big change. And then I'll pass it off back to Megan.
All right. And then the last thing we wanted to go over, we thought it would be timely to talk about what FDIC insurance is, as well as SIPC insurance. We've been getting these questions a lot with the recent banking chaos with Silicon Valley Bank. So we just wanted to take some time to go over those two programs, just so you have a better understanding of what those are and how they can impact you in the case of an unforeseen circumstance. So FDIC stands for the Federal Deposit Insurance Corporation, and it's a federal agency that protects you up to a certain limit against the loss of your deposit accounts if your FDIC insured bank fails. And a little history here, this corporation was actually established back in 1933 in response to the many bank failures of the Great Depression. So it was really created to promote public confidence in the banking system by ensuring those deposits. So some of the things it covers includes checking accounts, savings accounts, money market accounts, CDs, as well as cashier's checks and money orders. I want to point out here that the FDIC does not insure money invested in stocks, bonds, mutual funds, life insurance policies, annuities, and other things of that nature. Even if those investments were bought from an insured bank, the FDIC insures cash and CDs. And one way to know if the bank you use is FDIC insured is there will be an FDIC logo on your banking institution's website. So that's a really good way to know for sure if your bank is insured. And of course, if you don't see it there, it never hurts to ask and double check. And then finally, how much are you insured for? So the way this works is the FDIC covers you for $250,000 per depositor, per institution, and per ownership category. So if we go on to the next slide, I actually have a couple of examples to highlight how that works. So the first example is, say you're single and you do your banking at 2 different institutions. You have $50,000 in a checking account at Bank 1, $200,000 in a savings account at Bank 1 as well, and then a $250,000 certificate of deposit or CD at Bank 2. And so you can see that totals to $500,000, but all that money is protected. So that $500,000 is deposited as one depositor. So one person is depositing the money at 2 different banking institutions. So in this case, Bank 1 and Bank 2. And there's one ownership category, which means all of these accounts are singly owned assets. So since you have $250,000 at one bank and $250,000 at another, all your money is protected in this example. And so moving on to the next example, say in this one you're married and you both do your banking at one institution. You have $500,000 in a joint savings account shared with your spouse, and then a $250,000 CD in your name only. And that's a total of $750,000 at one bank, but all that money is protected as well. This is because the joint savings account is in one ownership category, which is joint. Both you and your spouse are covered up to $250,000 in that jointly held account because you are 2 different depositors or 2 different people. The certificate of deposit is in a second ownership category. It's singly owned by yourself. So you are the depositor, and then that account is also covered up to the $250,000. $100,000. So as you can see, there are many combinations of accounts and ownerships that can be combined for you to be protected on more than just the $250,000 stated limit. But I feel that these 2 examples really hit the point home of how it works and kind of what to look out for when learning about FDIC insurance.
Yeah, and then just to wrap everything up, right, to really understand and show the difference between FDIC and SIPC. So SIPC just stands for the Securities Investor Protection Corporation. And this was created under the Securities Investor Protection Act. And the SIPC protects the clients of brokerage firms that are forced into bankruptcy. So SIPC members include all brokers and dealers registered under the Securities Exchange Act of 1934. And then the insurance that comes with this, it provides brokerage customers up to $500,000 in coverage per customer for cash and securities held by the firm, with a $250,000 limit for cash. So the big difference here, right, is the insurance coming from the bank aspect compared to any type of securities, right? So we're talking about your stocks, bonds, annuities, municipals, anything like that. Probably this is SIPC and the FDIC are very complex, programs in place. So we do urge, if you do have questions, come please talk to us, because they're very, very unique. And then with that, we'll go ahead and hop into Q&A.
Okay, so that's going to get us into Q&A, everyone. So just as a reminder for anybody that has any questions, we encourage you go ahead and submit that into the question and answer box there. And then what I'll do is I'll go ahead and I'll get that pulled up here for us, and we'll start going through some of the questions that we have along the way. I'm going to go ahead and put the disclosures up really quick because I always forget to hold those up right, before the end. So here you go, everyone, disclosures. Let me pick those up real quick, right? All right, so let's do this. I'm going to go ahead and we will, we're going to drop the screen down. There goes. We just got the cameras, and Cole, let's get you back up here also. And then I'm going to pull our questions up. Okay, so one of the first questions that we have here is, okay, we got a couple here. I'm going to actually start with this one because you guys were just talking about insurance. And so there's actually a question about mentioning annuities. How are annuities insured? Would you guys like me to take that one? Because I kind of know a thing or two about annuities.
Go for it, Josh.
You got it.
Okay. All right. So where cash at the bank is insured by the FDIC insurance, right? And then we have securities that's insured by SIPC insurance. First off, annuities are issued by insurance companies. So typically, when you're going to look at it, they're backed by the claims paying ability of that organization. Now, that doesn't always make us feel super comfortable. There is a separate insurance guarantee fund. It's not at the federal level, though. It's at the state level. There is a state guarantee association for each individual state. And so you could actually go online and you could look it up, and you would have to see, depending what state you're in, what the actual insurance limits are for annuities in that state. Most of them are pretty much on track with FDIC insurance, about 250,000. I've seen some as much as 500,000 and some lower. So it does really vary depending upon what state you're in. But annuities themselves, and these are deferred annuities, not immediate annuities. So immediate annuities have already started paying an income benefit, whereas deferred annuities are sitting and growing. So hopefully that's helpful. With that, let's go ahead and jump in here. There were some that were a little bit ago. One is, when is a good time to stop saving into cash savings accounts?
I can take that one. The most famous answer in financial planning is it depends, but I can give a few guidelines for what to look out for generally. So in general, it's good to have about 2 to 6 months of cash savings on hand for emergencies. Typically, we say about 2 months for maybe someone who is married, has 2 incomes, and doesn't have a child. So just if someone loses their job, they have enough to get by while that person looks for a new job. But say you are the breadwinner for your family, there's one income for the whole family, you have kids, and then maybe there's some more complexity going on with your personal finances. It may be good in that case to have about 6 months of cash on hand, just in case of an unforeseen circumstance. You have enough to hold you over while you look for a new job, heal from an illness, or whatever the circumstance is. I will add in that maybe you do fit in that category of, being married with no children and dual income, but you're really risk averse and you'd feel a lot more comfortable having 4 months of cash on hand. That's totally fine too. It's not a hard and fast rule. If you want to have more than some of those minimums of cash in your accounts, but that's a pretty good range to live by if you want a specific number.
Yeah, I've also heard some pretty good suggestions. If you typically are receiving a steady income, right? I'm on salary. right? That 2 to 3 months, usually your expenses tend to be more fixed and level. Whereas if you're, let's say, paid by commission, where you get these big swings of ups and downs, that they would say that in that case, you probably want to have more like 6 months of expenses, just because of the way that your income comes in. So in other words, when you're going through periods where you didn't get a big month, right, and you didn't have the big swings, oftentimes we're dipping into our savings, right? Whereas other times we might be putting extra in. So that's why they say make it a bigger cushion if you have more variable income, because you're on, maybe some kind of a commissionable type job. So another, piece of food for thought there. Okay, so the next question that we have here is, could I change my investment strategy to be more or less aggressive?
Yeah.
My guess would mean, because that's like such a long time horizon, right? You're starting out super aggressive. Would you want to keep that aggressive allocation the whole way through?
Yeah. One of the, big topics that we talk about is, time horizon, right? How long do you want these, this assets to last? And what we really talk about is, all right, let's talk about the investment strategy at the beginning compared to the end. So when we were starting off and you're very young, right, your time horizon is longer, so you can take more risk. Well, let's just say, we're creeping up to retirement and we don't need to take as much risk, right? We could definitely change our allocation to say from an aggressive growth back down to a balanced growth portfolio where we, that's a more 50-50 based to equities and bonds. So to answer the question, yes, you can always change it. We probably don't recommend changing it a lot or too often, but yes, you can definitely change it compared to your living situation.
Yeah, I think the key piece there is that we're changing our asset allocation, maybe because our risk tolerance levels have gone down. There may be some strategic, reasons there. Right now, as an example, I think that there's a lot of folks that are allocating more from equities into fixed income or bonds because there's opportunity that's there, just with everything that's happened with interest rates over the past 18 months or so. But typically speaking, you don't want it to become this emotional decision that's happening. Oh, the market's going up, I need to buy, right? Or the market's going down, I need to sell. And you're making these asset allocation changes from an emotional level. That gets us away from that investor standpoint and more into that attempting to be a trader or day trader type of a strategy or philosophy.
Exactly.
So very good. Okay, it is 2:03. We've got one last question here, so why don't we try and jump on that one, and then we can let everyone depart for the day here. So what happens if I have too many of my assets in one location? Megan, Cole, who wants to take that one?
I'll take it. There's a few kind of facets to this answer. So the first thing that comes to my mind is, maybe for all these years you've just been focused on saving into your 401k. And that's the only saving you've been doing, which is not bad by any means, but maybe you're realizing that, okay, I need to move some of that savings into a brokerage account where the funds are a bit more accessible. Something that you can do is lower your 401k contribution, and that frees up some funds to be able to contribute to a brokerage account. When people talk about, how much should I save to my 401k if I'm not saving the maximum $22,500, we'll typically ask, well, what's your employer match? Is it 3%, 6%? Because you should at least contribute the match amount, so you get the full match from your employer and really maximize on the opportunities you have in that 401k. And then the rest can be used towards brokerage savings. Another thing that comes to mind is there may be times in life when you just simply have a lot of assets in one location. For example, you're young and you bought your first house. Frankly, most of your assets are going to be held up in your house because you used most of your savings to purchase that. That's not necessarily a bad thing. It just means that, okay, now you have to refocus and really start saving again into your cash savings and brokerage and retirement if you lowered it for that time. So there's always opportunity to shuffle that around, but it's just making sure you're aware of where everything's at in a given period.
Those are great suggestions. Thank you, Megan. Thank you, Cole.
Thank you, everybody.
Bye, everyone.
Thank you.